Hey, good morning once again, options traders. Well, a strategy that you don't hear of too often, at least by this name, is the Super Bull strategy. And I like to present this for a couple of reasons. First, if you ever hear this strategy by this name, you'll know exactly what it is. But more importantly, that it shows the importance of being able to break a strategy down. Because remember, all strategies are nothing but calls and puts, long and short. So you might be able to look at a strategy and say, all right, I don't know it by this name, but what is it? You might look and say, oh, it's actually a combination of this strategy and that one. And I do understand those. Or I can break it down synthetically and say, here's the way that it's going to behave. So keep that in mind as we go through and look at the Super Bull strategy. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So let's take a look at the Super Bull. It is probably more commonly known as the three-way strategy. And regardless of the name that it goes by, you're going to look at a long vertical call spread. It's going to be a debit, one that we pay for. And you're going to sell a put to finance that vertical spread. So really you're just buying a vertical spread and saying, okay, to reduce the value of the spread even more, I'm going to sell a put. Now, to do this, in most cases, it means that you are going to use an out-of-the-money call spread and will probably sell an at-the-money put, or at least closer to those ranges. And you'll see why in a moment. The idea is that we would like to get, relatively speaking, a lot of money from this put, which means we have to be more like at the money, and therefore we can also reduce the cost of the debit spread by making it out of the money. So for example, let's say that the stock is 100 and you buy the 105 110 vertical spread. Maybe it's trading for $1, but it's out of the money. And next you sell the $100 put, let's say it's trading for $3. Well, this gives you a net credit of $2. And what's the result? Well, let's break them down. Here is the sale of the $100 put. We all know we get a bend at the strike. We have unlimited downside with the sale of the put. And then if we overlay it with our 105 110 vertical, it looks like that. There's a bend at 105 and another at 110. So this is a bull spread. And the main reason for selling the put is we'd like to shift this portion of the blue graph of the debit spread above zero. And that's why you're going to have to, in most cases, sell the at-the-money put or something close and buy an out-of-the-money vertical. So we're trying to shift this part above zero. So again, remember that our stock is right here at 100, and so this is an out-of-the-money vertical and closer to an at-the-money put. And so when we do that, when we put the red plus the blue, or in other words, the short put plus the vertical debit spread, we get this. And this is the Super Bull strategy. So here's the portion that has now been shifted above zero. And we still have to be mindful, though, we still have unlimited downside risk. And this is the one thing that kind of has always perplexed me about the name of this strategy. They call it a Super Bull strategy. Well, if you're super bullish, why would you cap it up here? Now, on one hand, you could say I'm super bullish and I'm willing to buy an out-of-the-money vertical spread, and I'm willing to hold unlimited downside risk. And that's true, but it really leans more towards being not bearish. To be able to withstand that risk, you're definitely not bearish. But that doesn't necessarily mean that you are super bullish. So I've always found that to be a little confusing with this strategy, why it would be capped. But you can see the vertical spread right there. And then once we hit the strike of the put, we actually start heading into losses. See, notice if we just did the debit spread, we would be flat through here, but we would also be underwater. But because of the sale of the put, we're going to have some gains even down here to this put strike. So remember, that doesn't necessarily make it better. It just is a different set of risks and rewards. So before you start using this strategy, doesn't matter what you think. Remember, the market's going to do what it's going to do. Doesn't matter that you are super bullish. You have to realize you are still accepting unlimited downside risk. And that's really the big thing that you have to come to terms with before you use the Super Bull strategy. Now, like all strategies, there's a bull and a bear version. So if we did the bearish version, we're just going to reverse it. We're going to buy a put debit spread, but we're going to sell a call to help to finance it. And then we're just going to get this graph in red. So in this example, perhaps we have purchased the 90-95 put spread, which means that we are buying the 95 strike and selling the 90, and then we are also selling the 100 call. That's why we get the bend right there at 100. So right here is the vertical bear spread by buying the put spread, and then if the stock gets above 100, because we're short that call, we now have unlimited upside risk. So those are the Super Bull and Super Bear strategies, more commonly known as a three-way. But again, it doesn't matter what you call them, as long as you can look at these pieces and say, oh, it's just a vertical spread, and it's being financed by a short option. And that's really the bigger point to see. So now if you hear that strategy, you'll know exactly what it is. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.